Sunday, July 23rd, 2017, Monaco 64, home of alternative economics and contrarian views. So I like to talk about how gold and silver, physical gold and silver, are both wealth, and they're generational wealth, and they're not speculation. They will maintain the purchasing power of your savings. It is frustrating sometimes, but I'm gonna show you a few charts that show that gold and silver over the last 50 years have done very well. And even the correction we've had, in the last 6 years for gold has been very shallow. If you look at the percentage chart or the logarithmic chart. Silver, of course, has corrected more, but it's still maintaining its purchasing power. The secret is just like saving. You try to buy and gold and silver, regularly when you can, when you have extra fiat money. That's the secret. It's not chasing, only buying it, get involved when the market's making new highs. It's buying it every time, you can. And especially when you get big dips. And before I go into the charts, I want to talk about Jim Sinclair, because I've been following Jim Sinclair since 2002. So just when he started his blog, JS Mindset, and he's got a lot of good things, a lot of knowledge about the monetary system, about the markets. And I received an email from him, I think it was yesterday, and he says, QE to infinity, followed by gold balancing the balance sheets of the sovereign balance sheet disasters. Just as there is no tool other than QE to feign financial solvency, there is no tool to balance the balance sheet of the offending entities other than gold. It's just that simple. And that's Jim Sinclair. And I agree totally with him. Is it any wonder that the sovereign nations and their central banks still hold 30,000 tons of gold? The US, of course, has 8,300 tons, I think. There hasn't been an audit, I know, but they can very easily get hold of that gold. A lot of people say they don't have it anymore, but they can. They just have to go in the market and buy it through their bullion banks. And the other thing he says that's really interesting in this email, he talks about India, the changes they had last year where they scrapped some of their banknotes, and they're trying to get people into electronic money. But then he says the coming reset will be a combination of market activity and edict. Well, edict means that pretty much, let's say like in 1934, when the US government, administration, FDR, declared that gold was going to be reset from, $20.67 to 35. That's an edict. He thinks it's going to be a combination. He says, few, if any, know what it will look like, and even fewer will know how to make a fortune because of it. I understand how to do this, and so do you who have remained with us the last 14 years. So actually, I've been with him like the last 14 years. Some know and others will find out. We are on the precipice of a wealth transfer. Some of you are already prepared and just haven't realized it yet. So that's Jim Sinclair. And I just want to go over these charts now, which show, gold going back all the way to 1970, and it's a logarithmic chart. So the the price changes are in percentage. So here's the chart. Start out at $35 an ounce there in the early 70s. Then you had the bull market up to 1975. We went up to 200. Then we dropped to just around 103, I think. It was 103 the low in 1976. And then we had a huge move up to in January 1980 to 887.50. That was the high, intraday high, January 20th, if I'm not mistaken. So the move in percentage-wise, the move from the low in 76 to the high in 1980 was 1.682, proportionally bigger than the move from 1970 to 1975. So let's say if we moved 100% in the first leg, we moved 168%. It's almost also like a Fibonacci, almost 61.8. It was 62.8. So it's interesting. And the reason why I'm saying that is that I'm trying to predict what kind of move we could have, in the next leg of the bull market. And then of course we had the period from early 80s to 1999 where gold just languished. Basically it kind of was set there at 400. So even if you had bought it let's say in 1975 at $200, you'd still ended up well. What wouldn't have been good is if you just bought, went out and bought, everything at the top there at 887.50. It was frustrating, of course. It was like about 18 years of a bear market, maybe even a little more. And then we had since the low in 1999, I think it was around 253. We traded up to 1920, and I've made some calculations, and if we, make the same kind of move that we did in the 1970s bull market, and if the percentage move, next move up is 1.628 times the initial move from 2000, gold could get up to 11,000. If we see the same kind of percentage move that we've seen since that we saw, from 2000 or 1999 to 2011, we'd be around 7,000. So either way, I think we're set for a big move. And yes, it's been frustrating in the last 6 years, but if you'd been, accumulating gold, for the last 15 years, the correction we've had recently, in the last 6 years, percentage-wise, it's not even, 31.8%. So, we're at 1254. This chart shows you a lot better, those who have been investing in gold since the beginning of the century are actually doing quite well. And this is what a logarithmic chart does. It shows you the percentage move, and of course there's some people who bought right at the top, put everything right at the top. You need to do dollar cost averaging for gold and silver if you can. So now silver is a little different, is a lot more volatile, of course. But if you look here in the early 70s, silver, I think, was trading, around $1.50. There, the low in the early 70s. And then it went up, the Hunt brothers and the COMEX story. They say they try to corner the market. And then COMEX basically came out one day and said, you won't be able to buy silver anymore. You can only sell it. So much for a fair market. And then silver just collapsed. But looking at it generationally or long term, let's go. In 2000, you start buying. In 2003, 2005, yes, we've come off quite a bit more than gold, but it's still doing fairly well. And I think we've broken out in silver, as you can see by that falling wedge. And now we have a little falling wedge within the breakout. So, and the key level there is going to be 21. So for people who've been buying, since the early part of this century, yes, it hasn't been great, but they're actually, protecting their wealth quite well, considering we were down at 4 and right now we're at 16. So yeah, when we get through that 21, that could put the cats amongst the pigeons for the precious metals. We had a good close last week. Am I saying we're going to start moving a lot higher tomorrow on Monday? No. I mean, this is longer term. What I want to try to say is that yeah, it's not a get quick rich scheme, gold or silver, physical gold and silver. But if you have physical gold and silver, it will protect, you know, the wealth that you've accumulated. Because what is wealth? It's your effort and your, you know, work and your knowledge, and that's what it is. And Jim Sinclair is right. You know, when the sovereign nations need to reset their balance sheets, gold is going to be the ultimate you know, tool for them, and that's why they keep it in their balance sheet. Paper is not worth anything. You know, that's why they've built it. You know, they've built you know, a huge bubble in debt. So if you enjoyed this video, please like, share, subscribe to my channel if you haven't yet. And you can also watch me on steemit.com. That's STEEMIT.com. I'll talk to you later. Bye.